I spoke to Robert Buckland, the chief equity strategist at Citibank, and he was speaking about the overarching theme that they have moved from overweight emerging markets to underweight emerging markets and overweight developed markets. That theme definitely is what he thinks will dominate 2017. I also asked him about demonetization and whether he's pushing India down in the pecking order of emerging markets itself. Listen.
Well, it's very interesting. I've been on the road around Asia talking to investors, and the big global issues they're asking me about, we can discuss those in a second.
Yes.
But the interesting local thing is clearly the focus on what's going on here in India. And some of the trends that you're looking at are almost like exactly the opposite of what we're seeing elsewhere. Everywhere else, there's all the talk of interest rates going up, or here, potentially the talk of interest rates going down. So it's making India very specific in terms of what's going on elsewhere in the world. So there's a focus on India and what's different about India.
Let me first discuss where emerging markets themselves are because of the Trump victory.
Yes.
Incidentally, the Trump victory and demonetization hit us on the same day, November 8th.
Right.
But the Trump victory, how does it change your allocation of assets?
And I always say to my clients that there are two very important numbers that you need to focus on in world financial markets. The first one is the dollar, and the second one is US Treasuries. And those two have changed radically post the Trump victory. We as a house at Citi were dollar bears before Trump won. We're now dollar bulls. We as a house at Citi were US Treasury bulls prior to Trump winning. We're now US Treasury bears. So we've completely changed our views. Okay. And the knock-through implication of that for you guys in emerging markets is, in general, my clients sell emerging markets when the dollar's going up. My clients buy emerging markets when the dollar's going down. So it's been a change for us, and we've moved emerging markets from an overweight recommendation to an underweight recommendation as a result.
But you know, markets discount things pretty quickly.
Yeah.
The dollar is at 102 if you only took the index and not specific currencies. Can it really strengthen much more from here?
We've got an 8% appreciation of the dollar from here. So yes, it's done some of the work, but we think it can move further. And you were even seeing that yesterday in terms of financial markets. So that's always going to make life difficult for emerging markets, because the dollar going up is a liquidity contraction event. And a liquidity contraction event, as you are learning here in India, is not necessarily good for emerging market assets in particular.
Okay, what about the 10-year? The US Treasury went all the way to 2.34 and seemed to find a temporary peak there. How are you reading the bonds and therefore as an emerging market investor?
Yeah, I mean, you'll remember that number was 1.3 just after the Brexit vote in the UK back in June, July. So we've gone from a 1.3 yield to a 2.3 yield in just 3 or 4 months. And remember, for your viewers, yields going up are bad for bond prices. We think that number can go from 2.3 to maybe 2.6, 2.7 over the next 6 to 9 months. So maybe we've done 75% of the sell-off, the increase in bond yields, but we think there's more to go for. And there's always the risk in financial markets, which I always emphasize to people, is that they usually overshoot on the upside and on the downside.
Oh, so how should we understand the US Fed rate hike? Is one coming on December 15? And how many more in 2017?
Well, we think the Fed are going to hike in December, and we think the Fed will hike twice next year, and we think the Fed will hike twice in the year after as well. So that's 5 rate hikes from the Fed over the next 2 years or so. You've got to remember that it's just taking interest rates, which are currently sort of 50 to 75 basis points, depending on whichever measure you look at. That takes that number up maybe to 2% by the end of not 2017, 2018. So that is higher than where we are now. But if you say to someone in the US, interest rates are 2%, it's still a low number. So we need to put that into the mix as well, is that sure, rates are going up, but they're coming up from very low levels.
Okay. No, what is it for an emerging market investor, therefore? You know, last year we thought in December that the Fed rate hike had been discounted very well, and we saw this major dislocation, Chinese devaluation fears in January, and recession practically, at least, was a chatter.
Sure.
How will this play out, this Fed hike and the fund flows into emerging markets, say, in early 2017?
Well, interestingly, that sell-off that you described in January, February of this year, we turned overweight emerging markets
that.
Quite luckily, fortunately,
Made a lot
cleverly,
of money.
maybe, I don't know, whatever. We moved overweight emerging markets in January, February of this year. And you've got to remember, emerging markets as an asset class have been underperforming the S&P and so on for a good 4 or 5 years. So that was the first time we turned positive on emerging markets for 4 or 5 years. And the key driver behind that is that we became a dollar bear house. When we're a dollar bear house, you buy emerging markets. That trade was working really, really well until about 10 days ago. So the change in our house view on the back of Trump coming in, moving from being a dollar bear to a dollar bull, has basically killed off our attempt to maybe call a profound turn in emerging markets. So it's clearly playing out badly for emerging markets, and that's even before we start talking about trade and tariffs and all of these sorts of things. But in general, strong dollar, rising US rates, bad for EM.
Okay, so that, of course, is the big call. It's all